Kevin Warsh has taken over as the Fed chair. So let's talk about the first Federal Reserve meeting under his leadership, which had a rather hawkish note. And in particular, as many of you might be aware, it looks like quite a number of Federal Reserve members are predicting a rate hike in 2026, at least judging from the SEP. Many members are predicting rates are going to remain on hold in 2026, and only one Federal Reserve member predicted a rate cut in 2026. So Kevin Warsh and the Federal Reserve talked about what's going on with interest rates and also indicated what the Federal Reserve is going to be like under their tenure. So with this in mind, I recently sat down with TRT World News to talk about what is happening. And here's what I had to say.
A new era has begun at the US Federal Reserve with new Chair Kevin Warsh leading his first policy meeting. He held interest rates steady at 3.5 to 3.75% and sent a decisively hawkish signal to the markets. Warsh pledged to restore price stability, warning that persistently high prices remain a burden on American households. While the recent agreement between Washington and Tehran has helped ease oil prices, Warsh stressed that inflation risks have not disappeared and signaled the Fed is prepared to act if needed. Fueled by Trump's recent war with Iran, inflation has soared to 4.2%, more than double the Fed's target. The central bank also released a notably more hawkish set of projections. 9 of 18 policymakers now expect interest rates to be higher by the end of 2026, a dramatic shift from March, when no officials anticipated rate hikes. The outlook prompted investors to price in a potential hike as early as October. Despite being appointed by Trump, who frequently attacked former Chair Jerome Powell for high borrowing costs, Warsh asserted total institutional dependence. He immediately launched a structural revamp, slimming down the post-meeting statement and axing traditional forward guidance to break Wall Street's reliance on central bank signaling. He concluded his debut by launching wide-ranging reviews into the Fed's communication strategies and the reliability of its data sources. Describing the overhaul as a new chapter with fresh thinking, Warsh says the central bank will now force markets to adapt to a much more disciplined, data-dependent era.
Markets is a new chapter for the central bank, some fresh thinking. What we've given markets and households and businesses, I think, is a commitment to ask ourselves hard questions such that we can deliver on the promises that we've made before. This is a lot of change for financial markets to digest.
Joining us now for more is Mark Humphrey-Jenner in Sydney. He's an Associate Professor of Finance at the University of New South Wales Business School. Good to see you, Mark. Now, President Trump appointed Warsh specifically to slash borrowing costs, yet Warsh's first move was a massive hawkish shock. And Trump says he's fine with it for now, but how long can this honeymoon last before the White House starts taking aim at the Fed once again?
Well, firstly, thanks for having me. And it was an interesting first meeting. Indeed, I think that Kevin Warsh felt like he probably needed to signal that he wasn't going to be excessively dovish, because there had been fears that Kevin Warsh was being put in there just to cut interest rates, even though inflation was very high, which is why we saw them keep rates on hold. And specifically, he referred to the dot plot and did not offer a forecast of his own. So referred to the dot plot, which had 9 members forecasting a potential rate hike, 8 members forecasting rates being on hold in 2026, and only 1 forecasting a rate cut, which would have made it incredibly difficult for Kevin Warsh to try to strong-arm the Fed into cutting rates. Now, in terms of President Trump's rhetoric surrounding this, it will remain to be seen in future meetings. After all, in the current meeting, we still had the turmoil in relation to Iran. But if, for example, inflation starts heading down and the Federal Reserve still remains hawkish, it's quite possible that President Trump will start browbeating the Fed again.
And Warsh has put inflation front and centre even as oil prices have eased following this agreement between the US and Iran. Is he right to remain this concerned about inflation?
It's absolutely right for them to be vigilant about inflation. After all, throughout 2026, we've seen on again, off again, truces and ceasefires in the United States and Iran. And we are heading in the right direction. It looks lasting ceasefire. But of course, it's too early to say it is necessarily going to stick. So the Fed absolutely needs to be cautious and vigilant about what might happen going forward, which is why they kept rates on hold and why many of the members were thinking that rates will remain on hold for the moment.
So we can see the Federal Reserve is keeping rates on hold, at least for the foreseeable future. The S&P 500 was down on this news. But of course, the S&P 500 has been doing very well recently. So this is just a recent blip downwards. So it remains to be seen exactly whether this is really going to cause the rally to come to a halt. After all, if it is that the economy is going to improve in large part, or at least partly, due to what's going on with tech companies such as SpaceX and various AI companies, but also the ceasefire between the United States and Iran, then you've got positive news being somewhat offset with negative news, such as the higher interest rates. Now, like I've indicated, it looks like the Fed at this point might hike rates in 2026, which is why the 2-year rate increased in the market. Now, in terms of what the Federal Reserve is otherwise doing, Kevin Warsh indicated there might be other reforms within the Federal Reserve. Part of this comes down to communication strategy. We saw his particular statement being rather shorter than that under Jerome Powell. But of course, communication is only one part of the equation. If the underlying decisions remain the same, then how you communicate it, well, the market is just going to adjust to this. Obviously, you want to make your communication better over time. Better communication is always inherently better than worse communication, and making clearer statements that are easier for the market to interpret is always better than opaque statements or having statements the market needs to trawl through to try to decipher like a Rosetta Stone to work out what the Federal Reserve is doing. However, that's only a small part of the equation. I think the bigger part of the reforms is looking at what data is guiding their decisions. After all, if you have garbage going in, you have garbage going out. And there have been some concerns about the veracity of some of the data the Federal Reserve is relying on, and some concerns about whether some of the data is too backward-looking and is not prospective enough. That is, there are concerns about whether the Federal Reserve is acting too late because it is always being data-driven, which is good, but some of that data is stale. So reviews into that, I think, are going to ultimately be welcome if they make the decision-making better. Now, in terms of what this means going forward, I think to some extent the market might be slightly relieved by the nature of this decision. Now, obviously, the stock market was down on the decision, but what I mean by relieved is there were some concerns that Kevin Warsh would be brought in just to lower interest rates because President Trump wanted him to lower interest rates. What appears to be the case is that Kevin Warsh is trying to act in the most appropriate manner possible given the data and given their forecasts in place. The fact that there was a hawkish note to some extent indicates that he isn't just going to lower rates because President Trump wants him to do so. It indicates a continuation of the separation between the Fed and the presidency, which I think is good news for markets going forward. Even if this specific decision and this specific rhetoric about hawkish decisions obviously is negative for stocks, the independence of the Federal Reserve is long-term better than would otherwise be the case. But of course, you can let me know your thoughts about the Federal Reserve's decisions in the comments below. Do you think they got it right? Do you think they got it wrong? What do you think the Federal Reserve should do? And what do you think about Kevin Warsh's tenure as Federal Reserve Chair? Let me know your thoughts in the comments below.